Welcome to Market Catalyst. I'm Jared Blikre. We are 30 minutes into the U.S. trading day, and let's get to the three market catalysts that we're watching this hour. First up, President Trump's nominee to become the next Fed governor is on Capitol Hill today. Stephen Miron facing questions from the Senate Banking Committee as he vows to preserve Fed independence. We are live on the Hill as the hearing gets underway. Plus, Salesforce sinking after third quarter guidance fails to impress. Where did the company go wrong? We talked to one analyst about how it compares to other names in the AI trade. And American Eagle soaring to a fresh 2025 high as new celebrity ads boost sales. Can the momentum last? We're breaking it down. All that and more coming up on Market Catalyst. And let's get a quick check of the markets here. We got the Dow in positive territory, but just barely, up about 60 points or 0.1%. The NASDAQ up about 17 basis points here. And this is the price action over the last 2 days. We're coming off a nice win for the NASDAQ and some of the other markets. And the S&P 500 up 17 basis points as well. Also, I'd like to get a quick check of the small caps because they are leading this morning up about, 0.4%. And you can see they were underwater most of yesterday. And we got to check in on the bond market. Yesterday was a big drop in the 10-year and the 30-year, even the short end of the yield curve. And today we are seeing some continuation to the downside, down 0.2% or 2 basis points in the 10-year. And by the way, 4.19% is a 5-month low. And then taking a look at the 30-year tracking mortgage rates, that is down 2 basis points as well after the biggest drop since August 1st yesterday. So we're going to be tracking all of that. And a quick check of the sector action as well, because consumer discretionary led by Amazon, that is our leading sector today in the retail space, up 1%, followed by real estate, consumer staples, and financials, all of those up more than 5%. In the red today, we have materials and tech leading to the downside there, down about 0.6%. And President Trump's nominee for the Federal Reserve Board, Stephen Miron, he is facing his nomination hearing before the Senate Banking Committee. And Fed correspondent Jennifer Schonberger, she is live on Capitol Hill as the hearing is set to get underway. Jennifer.
Good morning, Jared. I'm here in the hallway, just in front of the Senate Banking Committee hearing room, where President Donald Trump's nominee to the Federal Reserve Board, Stephen Miron, is seated inside, set to take questions from lawmakers on both sides about his views on monetary policy. Front and center is expected to be questions on Federal Reserve independence. Just ahead of this hearing, Senator Elizabeth Warren, the ranking member on the Senate Banking Committee, gaggled with reporters tearing into President Trump's nominee and what this means for Fed independence. Take a listen.
He has made clear that his loyalty is not to the American people, not to the numbers, not to independence, but to saying whatever it is that Donald Trump wants him to say. In countries where the president has managed to seize control of the central bank, the bank that functions like the Federal Reserve, we've seen the disaster that follows, and that is that inflation shoots through the roof because people have no confidence in the economic decision maker. They believe they're just one more political actor, and that's going to cost every American.
Senator Warren also said that if it was not for President Trump's policies and uncertainties around tariffs, that the Federal Reserve would already be cutting rates, something that she also favors, but says that she highly respects the independence of the Federal Reserve and keeping inflation in check. Now, Republicans will be on watch as well for what questions they ask Miron about Fed independence, while trying to walk that tightrope while also confirming the president's nominee. Should be an interesting next couple of hours here on Capitol Hill. Jared?
You bet, Jennifer. And we're going to be checking back in with you, so thank you for that. And some key economic data out this morning. The August ADP report flashing a signal that the job market is slowing down. The private sector added 54,000 jobs last month, and that was worse than the estimate of 68,000. And it comes ahead of the monthly Labor Department report this Friday. Meanwhile, moments ago, ISM released the data showing economic activity in the services sector came in at 52. And that compares to the 50.1 rating we got last month in July. The consensus on Wall Street is that the Fed will will cut rates at its next meeting next week. But that near certainty is outweighed by plenty of economic uncertainty, making it difficult to pinpoint Fed policy going forward past those meetings in the future. So let's widen the lens a little bit more and take a bird's eye look at the economy. I am joined by Robert Sabatino, UBS Asset Management Head of Global Liquidity Portfolio Management. Thank you for joining us here today. I just rattled off a bunch of statistics about some of the economic data that we've gotten recently. And of course, we're looking ahead to Friday because we've seen weakness in the labor market so far in some of these recent reports, including jolts yesterday. What are you making of all this?
Yeah, I think you're correct in pointing to unemployment, right? We've heard from numerous Fed officials that is outweighing any concerns about inflation, and that's why they're going to cut 25 basis points this month. Clearly, there's slowdown in job growth. The Fed cutting 25 and waiting to see, what happens, how the data comes in the next few months, I think is appropriate.
And there's been a little bit of a shakeup, maybe a lot of bit of a shakeup at the Fed with the Lisa Cook being fired, and she is battling that in court. But it could kind of reshape the Fed next year. And President Trump could actually have a lot more control over the Fed votes coming next spring, especially at that March meeting, if all of this goes through. I'm just wondering what that means. It definitely implies that there's going to be an easing bias, and we've seen short-term rates come down in anticipation of that. Do you see this playing out, and what are the repercussions for investors?
Sure. Yeah, I think as Trump gets to nominate more Fed governors, there is an impact, but he's not controlling rates, right? Ultimately, whoever's in whoever's in the seat needs to look at the data, right? They need to support why they're taking one position over another. Sure, there's doves and hawks, and we're likely to be in a position where we have a more dovish Fed, which means lower rates. But ultimately, it's going to come down to what the economy is doing, how inflation and unemployment play out.
All right, I love that you have a bird's eye view of the global plumbing, and this is from the perspective of money market funds, and we don't talk about these a lot, but short-term liquidity influences stocks and bonds and what they do on a day-to-day basis. It can be the swing factor, and we've seen the U.S. Treasury front and center in pulling a lot of these levers here. We had the debt ceiling recently raised. There are a lot of factors going in here. We might even see quantitative tightening end at the next September meeting. But what is the global liquidity situation right now, and what do you think that portends for stocks and bonds?
Yeah, you highlighted a bunch of factors that are at play right now, right? We have digested tremendous amount of Treasury bill issuance after we had raised the debt ceiling. The market was able to handle that without any problem. It was almost $600 billion in issuance since July. I think it speaks to the nature of money markets, right? We are an industry that is used to dealing with incoming information, deploying assets in a very safe and liquid manner, and ultimately, the market's functioning. You do have periods at month end, quarter ends. We're coming up to corporate tax date, so middle of September, where you could have a little bit of pressure on funding. And I think we heard from Dallas Fed Logan the other week, just letting the market know that there are facilities in place, like the standing repo facility, in case any banks or broker-dealers want to take their Treasury positions and turn it into cash.
So in other words, there is that backstop there.
Correct.
I want to ask you about the cash on the sidelines argument that I hear a lot in the financial media. So there's $7.2 trillion parked in money market funds, and the theory goes, well, this could just come rushing into stocks any moment. But I've looked through history at the charts of when these rates actually come down, and it usually lags the Fed by quite a long time. And so the Fed will lower short-term rates, and it takes people a year or two to figure out that they're not getting 4, 5, 6% in their money market account. Then that cash leaves, and sometimes by that time we're already in recession. So how do you see this global liquidity situation? The $7.2 trillion on the sideline, is that a good thing? I mean, is that a backstop?
Yeah, it's not on the sideline, right? Investors are actively choosing to be in money market funds, right? They like the safety, liquidity, and the market rate that we provide. If you look at other cash type vehicles, deposits, let's say, those are administered rates. And sometimes they're lagging the market dramatically. So what we've seen, we came off a period of a zero interest rate environment where money market assets remained very stable. And then the last 9 years, we've had incremental growth every year. We've had tremendous growth the last 3. I see that continuing, right? No one argues that growth in the equity market, gold hitting all-time highs. No one questions that, right? But they question these assets and money market funds. And also, I don't think we spend enough time looking at deposits, right? Deposits
like in bank accounts. How much is in my checking and my savings?
So it's over 18 billion. So there's a tremendous amount of cash that investors are choosing to keep liquid. At the end of the day, there's so many concerns geopolitically with tariffs, with interest rates, that many investors enjoy the safety and the yield that they're getting in money market funds. And even if we saw decline in rates, as you correctly stated, there is a lag. So we don't immediately lose assets, and going from a 4% money market fund yield down to 2.5 to 3 is not the end of the world. We're not going back to zero.
I hope not. What would that imply? Really appreciate your time here, Robert Sabatino. Thank you. Sabatino, thank you.
Great, thank you.
And coming up, a large part of President Trump's trade policy could be up to the Supreme Court. We're going to break down what's at stake next up on Market Catalyst. President Trump asked the Supreme Court to weigh in on whether he can use the Emergency Powers Act to impose sweeping tariffs after an appeals court upheld an earlier ruling that found it unconstitutional. For more on the future of trade policy, I want to bring in Ben Werschel, Yahoo Finance Washington correspondent, and Henrietta Trey. She is a Veta Partners managing partner and director of economic policy. So Ben, let's start with you. What is at stake with this decision right now?
Yeah, morning, Jared. Yeah, there is a lot at stake here with this decision. The underlying question is the legality of Trump's so-called IEEPA tariffs, which is a huge chunk of the $180 billion plus that the Trump administration that's been brought in by the government this fiscal year. At stake is not just whether these tariffs can continue, but there's even a scenario here where the Trump administration is forced to offer refunds if it's found that these tariffs were put in place illegally, and so that they shouldn't have been collected in the first place. So that would cause a lot of chaos in any scenario if these tariffs are struck down. The Trump administration priority at the moment is speed. That's what this petition to the Supreme Court that was formally sent last night is about. It's about getting the decision done, not just getting the decision done, but getting it done quickly, as opposed to the sort of full Supreme Court decision-making process that could stretch things out into next spring. The Trump administration wants this to be handled quickly, a decision to be coming quickly, and the Trump himself has said he's confident of a victory there. Whether he gets his way on this speed question is a much more open question. I've been looking at some Supreme Court experts this morning, and they note that a rapid-fire decision, as opposed to rapid-fire moving on an injunction, is a pretty rare thing. There needs to be usually a pretty hard and fast deadline. The big example there would be Bush v. Gore, when the Supreme Court decided on that election because there was a clear deadline there with Inauguration Day approaching. So what the Supreme Court decides to do here remains to be seen, but Trump is already floating that if it doesn't go his way, he may need to sort of redo his whole trade policy, including the unwinding of trade deals we've seen from Japan to Europe and South Korea.
Henrietta, I want to bring you in here. We were just listening to Ben kind of outline and game out the potential scenarios. I want to know your opinion of how you see this going and what could happen, what could swing things either way.
Well, the Supreme Court ordinarily wouldn't even hear this case because the Court of International Trade and the Court of Appeals have both reached the same conclusion, which is that Trump doesn't have the authority. No president has the authority under the 1977 International Economic Power Emergency Act. So there is a plain precedent for the administration never using these tariffs, Congress not having given the president taxation authority here, and especially not on the sweeping scale that he has imposed over what has been, decades-long issues for the United States in terms of trade deficits. So the cut and dry answer is that the Supreme Court is likely to find on the legal question that the president doesn't have the authority to impose these tariffs. Moreover, they've also decided in the last couple of months that, and when a president acts too aggressively, it violates the major questions doctrine and says basically the president is asking outside of his purview. He's not in his lane anymore. Congress needs to decide these things. So my base case with 50 to 65% odds is that the Supreme Court will side with the two lower courts and say the president doesn't have this authority. You can see from the president's filings with the Solicitor General, that they're trying to say, look, don't even limit it. Don't make it a short-term tariff. Don't make it applicable in only certain instances. We want this wide latitude. And that goes to the heart of the major questions doctrine. So my base case is that sectors are going to get really aggressively hit in the next couple of months as the IEEPA authority is overruled. And that's where we need to concentrate. Furniture, lumber, timber, aircraft, trucking, pharma, semis, that's what's going to get hit in the immediate aftermath of this court case.
And I'm glad you brought that up, because that leads to my follow-up here. The next question is, what happens if the Supreme Court decides not to hear this and the lower courts their rulings are upheld here, their decisions are upheld? What are these businesses to do? What can they expect? How long is it going to take for the Treasury to return some of this money?
Yeah, man, it would be wild if the Supreme Court just rejected the president out of hand. The base case expectation is that Justice Roberts will not do that, and they will take up this case, and we'll get a conclusion, as Ben suggests, by November, December of this year, as opposed to February or March of next year. So they are moving quickly. It's a $4 trillion question. So this is obviously very critical. The plaintiffs in the case, which are domestic importers, companies selling learning materials to students and children, for example, all these domestic U.S. companies who import products from abroad. Just like John Deere would in terms of steel and aluminum, importing it from abroad. You see the impact that it's having on John Deere and Caterpillar and those companies right now who are forced to pay these massive tariffs. They want their money back. If these are illegal tariffs, they want their money back. And by the way, they want interest. So this is roughly $150 to maybe even $300 billion worth of refunds that the Treasury would be required to dole out. It'll be very complicated and probably won't be sorted out for months to come.
All right, and then the second part of that is, what are Trump's options if the Supreme Court either doesn't hear it or rejects the ability for him to charge these tariffs? I understand that he can still legally charge or implement tariffs on specific sectors up to a certain percentage. How could that play out?
Well, there are a couple different options. The Section 232, the national security tariffs, are already in place. I mentioned that on steel and aluminum. Those are 50%. All those pieces can stay. Whole nations could be exposed to Section 301 investigations. The China tariffs are in place across $550 billion worth of goods. About $350 billion worth of goods are tariffed under 301 already. He can just migrate those quickly. For the rest of it, though, which is about 70% of that $4 trillion number I mentioned earlier, that would be best addressed if Congress were to actually give the president this authority and say, hey, yeah, we actually do want you to tariff every single import to the United States and tax the average family $2,700 per year. Here is that authority. And they could do that. The Republican conference could give the president that authority. That's what he'll want, and that's what he'll be asking for. And a good legislative vehicle for that would be the reconciliation package that they could begin writing on October 1st. So our advice to clients is watch the House and Senate Republican conference and see if the president is going to compel the Republican Party to vote for taxes on all consumers at these very high 50, 60% rates, which is what the current IEEPA tariffs are collecting from Vietnam, South Korea, Indonesia, Malaysia. Those very high tariff rates are in place there. And Congress could give them the authority if they just say yes.
We'll be on pins and needles here. Ben, I want to circle back to you on a slightly different topic, because tonight in the Rose Garden at the White House, the president is welcoming top business, political, and tech leaders. We don't have an official guest list that I understand, but Mark Zuckerberg is supposed to be there, Sam Altman of OpenAI. What do you know about this event, and how could it shape things, the tech discussion and the relationship between the tech industry and the White House?
Yeah, so this is going to be the first kind of gathering of Trump's remodeled Rose Garden. He paved over the lawn and made it into a patio, kind of made it into a lot of echoes of Mar-a-Lago. And as you mentioned, tech is the very first kind of guest list here. Trump has been planning for a party for a couple of weeks now, and then it's there. A couple other names for you. I think you mentioned Zuckerberg. Bill Gates is apparently on the guest list. Apple CEO Tim Cook. This is according to an invite list that the Hill obtained first, but has since been confirmed by the White House. So it's going to be a real tech gathering. Exactly what it is, we don't know. It's right now it's closed to the press, so I don't know that we're going to get remarks, but it's also coming as Melania Trump has an AI event today that I think a lot of these same CEOs will be at. So kind of a tech-focused day and an unveiling for Trump of this. The White House statement being distributed to reporters is calling this the Rose Garden Club. I'm saying top business, political, and tech leaders for this dinner will be in attendance, calling it the new beautiful Rose Garden patio. So Trump's definitely looking to show off this patio, and he's using tech as his big first way to do it.
The new beautiful Rose Garden patio. Well, we'll wait for that tonight. Thank you, Ben, and thank you, Henrietta. And all your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 1 hour into the trading day. And you're not seeing stocks do too much, although we are currently in the red across the board here when it comes to those major indexes. Actually, I lied. We're in the green here. You're seeing the Dow up 0.1%. The S&P is up roughly 0.2%. And same with the NASDAQ, coming off of those lows that we were just seeing throughout the morning session. We'll see if we can continue to trade in positive territory here. I also want to take a look at some of the tech components of the NASDAQ 100 because you are seeing Amazon up over 3%. This is following news that Amazon Web Services is building data centers at record speed. Over 1 gigawatt of capacity is already in the final stages for Anthropic AI. That is its anchor customer. So that's fueling some of the gains that we're seeing this morning. In the meantime, I also want to take a look at some earnings movers today, and one being CRM, Salesforce, also coming off the lows that we saw earlier in the session, but you are seeing this steep drop. We are down over 6% today, and this comes after the company's Q3 revenue forecast fell short, while its AI initiatives gaining traction, still remaining too small to move the needle there for investors. So just another example of how a lot of these companies, especially those software players, are still exposed to that AI trade. And this comes despite the fact that Salesforce did beat in the second quarter with revenue topping $10 billion. And then finally, let's take a quick check on the bond market. We have been focused on the bond market throughout the course of this week after we saw that sell-off on Tuesday. However, you are seeing long-term treasury yields tick lower. We have the 10-year down about 2 basis points. We are below 4.2%. And the 30-year yield is down roughly 1 basis point, now below 4.9%. If you take a look at the 5-day, you'll see how we spiked close to that 5% level. That is a level we have not seen since July, and it is a critical threshold when it comes to how equities tend to perform. Typically, when longer-term yields are trading at those high levels, 5% for the 30-year, you tend to see equities under pressure. So that was something economists and investors were a bit concerned about earlier in the week, but it seems like we have more buying in the bond market at this point, especially after that ADP report just confirmed further softness on the labor side of the equation, and that all sets us up for tomorrow's critical jobs report. But keep it right here on Yahoo Finance. We'll be tracking all of the market moves throughout the session.
Now time for some of today's trending tickers. We're watching Ørsted, GM, and Atlassian. First up is Ørsted, the company filing a lawsuit against the Trump administration. The suit comes as Ørsted looks to revive construction of its wind farm that the government blocked. Therefore, the company is seeing an order forcing the administration to let it finish the project. The Revolution wind farm was intended to provide energy for homes in Rhode Island and Connecticut. Next up, General Motors. The automaker reportedly slashing output at one of its main electric vehicle factories. According to Reuters, during the month of December, GM will stop production of 2 electric Cadillac SUVs at its assembly plant in Spring Hill, Tennessee. This move would add to the running list of automakers pulling back on electric vehicles as a federal EV tax credit is set to expire later this month. And finally, a look at Atlassian as it agrees to acquire the Browser Company, a startup that offers a web browser with AI features. Atlassian will acquire the company for approximately $610 million in cash, inclusive of its cash balance. The companies aim to close the deal in Atlassian's second quarter of its fiscal year 2026. An Atlassian CEO noting this deal as a bold step forward in reimagining the browser for knowledge work in the AI era. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. And Salesforce sinking after its third quarter outlook fails to impress. Still, the software company topped second quarter expectations on the top and bottom line. And joining me now is Rishi Jaluria, RBC Capital Markets Managing Director of Software. And Rishi, let's start out with this. You lowered your price target on the stock from 275 to 250 on the back of these results. So how are you seeing Salesforce and what led you to that decision?
Yeah, absolutely. And thanks so much for having me. Look, I think all things considered, it was a pretty good quarter. But right now we're dealing with these maybe existential, bear cases in software of, what does AI mean for seat count growth? Can, the incumbent software vendors really do enough on the AI front to avoid disintermediation or disaggregation risk? And, in spite of a lot of the bullishness that they talked about with Agentforce, with Data Cloud, with some of the other AI initiatives that they have, it just wasn't enough to offset that. And I think at a time where we're seeing peer multiples come down, where you saw maybe a little bit more of a muted outlook than I think investors were looking for, which is why I think the stock is off this morning, and really just not enough to offset that bear case. That's why I did lower my target a little bit. And have some real concerns around maybe how meaningful Agentforce can be in the near term.
And let me broaden that because we're talking about hype and that can surround AI, but also acquisitions. Are they relying too much on acquisitions? Like in the past, they had Slack and Tableau, and now it's Informatica. How are you seeing that develop?
Yeah, look, it really does feel like a little bit of a return to, I don't want to use the phrase empire building. That's maybe a little bit too harsh, but a little bit more reliance on acquisitions, I think should be right. Look, I mean, to me, especially entering this post-AI world, I think, innovation, especially organic innovation, is super important. And you can obviously supplement that with, more tactical M&A. But I do worry about the Informatica acquisition, that it becomes a distraction. It does signal maybe a return to the old ways. If you recall, Salesforce's stock hit lows, after digesting the Slack acquisition, and then with a little bit of a promise of no more big M&A and focus on margins, the stock started to do well. And now we're kind of in this no man's land again. Don't get me wrong. I understand the industrial logic behind the acquisition of Informatica and layering alongside MuleSoft and Tableau, two other acquisitions. But really, I think at this point, organic innovation is what I'd like to see a lot more out of Salesforce rather than M&A. So that was a worrying sign for me. And actually, the Informatica deal is what tripped me to actually downgrade the stock from outperform to sector perform when it was actually formally announced.
You just talked about wanting to see organic growth. Let me bring it back to Agentforce because they've signed over 12,500 deals. Is there a magic number or maybe some other statistic or maybe a statement from management that gets you excited about this and maybe thinking that, okay, AI, they're doing it right?
Yeah, look, to me, actually, it's going to come down to what's customer feedback. That's the, when I talk to customers, when I talk to, technologists and developers and, VCs and private companies, what are they saying about the product, right? Because it's obviously Agentforce has been marketed incredibly well. Everyone's heard about it, whether they really know what agentic AI is or not. But I think the question then comes down to how much value is it actually delivering, right? I mean, they talked about that 12,500 deals and 6,000 paying customers. A lot of those are still kind of on that kind of quasi-premium pilot proof of concept stage. But I think we'd have to see more of this really move into live production and delivering real tangible value and real tangible ROI for customers. And if I start to get the sense from those conversations that the actual technology behind Agentforce, is kind of delivering on the promise that we've been hearing out of Mark Benioff for the past year, then I think I would get a lot more excited. As it stands, I'm not here yet, but their conference is next month, and I'm hoping for some positive surprises out of that.
All right, and then we got about 40 seconds left here. Any final words to investors about Salesforce? And it could be about the conference that we're looking forward to.
Yeah, look, I think the conference is a great opportunity for Salesforce to kind of regain control of the narrative. If we were to have this conversation 8 months ago, it's, when Salesforce was at all-time highs and everyone was super excited about Agentforce and this was going to be the next growth driver. I think investors need to be patient when it comes to AI altogether. But I think really Dreamforce, the conference, is a big opportunity for them to come out with some new product announcements, really talk about why they have an advantage in terms of Agentforce, in terms of their data, in terms of the workflows, context, all that kind of stuff. And so very much looking forward to that. I think any investor looking at Salesforce should be paying very close attention to the keynotes and any major announcements that come out of Dreamforce.
All right, we will put that on our calendar. Really appreciate your time here and your insights, Rishi.
Thank you.
You bet. All your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Well, the Federal Reserve says U.S. economic activity saw little or no change across most of the country in recent weeks. It's from the Fed's Beige Book, a publication about current economic conditions across the 12 federal districts. It comes as job openings slipped in July, more evidence of some cooling across the labor market as the Fed weighs a rate cut later this month. And joining me now, we have Dennis Lockhart, former president of the Federal Reserve Bank of Atlanta. Dennis, always great to see you. So let's start there, Dennis, with some of the economic data and commentary we got. We did just this afternoon get the Beige Book, Dennis, and it's some interesting commentary there. Contacts, it says, reported flat to declining consumer spending for many households, it says. Wages failing to keep up with rising prices. That doesn't sound great. Combine that with the JOLTS job openings, Dennis, we got this morning. That came in below expectations. Add it up for us, Dennis. Your baseline expectations for the U.S. economy. What are you forecasting, Dennis, now and ahead?
Well, there's still a lot of uncertainty, and the tariff picture is an important part of that uncertainty. Clearly, the economy is slowing and the labor market is slowing. I think it's debatable whether what we're seeing in the labor market is a late cycle natural slowdown or something worse. And I think some of the FOMC members are now beginning to become more concerned that it's something worse, or it could be something worse shortly. And that's the reason we're hearing more voices consider a rate cut at the September meeting. So
the market, of course, then is expecting a cut at this meeting. Is that what you expect? And to your point about, we have economists come on, Dennis, and they say, listen, it's despite maybe their worries about inflation, the reason they'll argue that cut is a lock, they'll say, Dennis, is because the labor market is weakening, and when the labor market starts to weaken, things can go south quickly. Is that your take?
Well, the speed with which the labor market could deteriorate is really an important consideration. Having said that, I actually believe that this meeting will be more of a close call than the markets seem to have priced in. The inflation picture has not really improved, and it has deteriorated just a bit, particularly at the core level in the most recent reading. And they're still substantially above the 2% target. So it will depend a little bit on how the committee breaks between those who really want to prioritize inflation and inflation expectations, as Raphael Bostic said, or those who are really concerned that we're going to see a rapidly deteriorating labor side. I don't think it's a clear picture. I think there'll be voices on both sides.
On the tariff-induced inflation, Dennis, the big debate seems to be among our policymakers whether you think, listen, it's going to be transitory. It's going to be this kind of one-time price level shift, kind of like if you got a poor harvest. That seems to be where Waller is at. Or do you think, no, that's wrong, this could be actually more persistent? Where do you come down?
Well, I think you have to be cautious about coming to a conclusion on the transitory theme. The inflation picture could play out not necessarily persistent, meaning 2 or 3 years, but persistent enough over several months that inflation expectations begin to shift and something a little bit more, let's just say a little bit more troublesome begins to develop. Logically, it should be a one-time event, but look at the way the tariff policy has actually been implemented. It's been on again, off again, lots of uncertainty as to what's going to actually happen. And now we have, of course, the court ruling that puts in doubt the overall picture on tariffs. So if I were a business person making decisions on pricing, I'd remain cautious and bide my time if I could, but begin to think about pushing those price increases through if tariffs stick.
I do have to ask you, while I have you, Dennis, about the ongoing Trump-Lisa Cook story. Bill Pulte saying he's going to have a press conference tomorrow morning on this. You saw Lisa Cook's legal team firing back, saying Trump doesn't have, valid reasons to fire her, deny these claims of mortgage fraud. What do you make of this story, Dennis?
It remains to play out, and it will play out apparently in the courts. I understand there's been one hearing, but no ruling. So we'll see what that ruling turns out to be, and then in all likelihood, there could be an appeal or a move to a higher court level. I think the really important question on the rate cut in September is whether Lisa Cook will be able to participate in that meeting, and whether Steve Myron will also be confirmed in time. You could have quite a different makeup of the governor's side of the room, depending on how that plays out. The Lisa Cook thing is going to be adjudicating what for cause means, and we'll see what the courts actually rule on that.
I want to get you on this, Dennis, because there are broader questions being raised, including on this program by different economists and strategists about Fed independence with all this. Former Treasury Secretary Larry Summers was talking on Bloomberg TV, and he said, here's what he said. He said, we're on the foothills of a credibility crisis. We are in completely unprecedented territory. You agree with that, Dennis?
I agree. We're in completely unprecedented territory. This has not been a one-time event, as we saw in history with Nixon or with conceivably Lyndon Johnson. This has been persistent now for many, many months, and is unlikely to end, no matter how some of these questions around Cook and others play out. It appears to be an effort to put a bunch of allies on the board of governors. I think it's a serious matter. I happen to be one who believes that independence in formulating monetary policy is a fundamental of good governance in the country, and what we've seen has already done some damage to that, in my opinion.
Dennis, we always appreciate your time and your insight. Thank you, sir.
Thank you, Josh.
American Eagle shares soaring after topping Wall Street's estimates in its second quarter. The company citing the success of its controversial ad campaign with Sydney Sweeney, as well as its new partnership with NFL star and Taylor Swift's fiance, Travis Kelce. Joining me now is Corey Tarlow, Jefferies Senior Vice President of Equity Research. So let's start out with this. Corey, can American Eagle expect this celebrity kind of boost to hold through the holiday season? Like, how long does the Taylor Swift effect last?
That's a great question. And if I had a crystal ball, I'm sure I would love to give you the answer. But I think that the idea here is that this is something that they're going to continue to leverage throughout the back half. They've committed to amping up marketing spend over the coming months. So they've guided to high single-digit SG&A growth for Q3, and embedded within that is advertising spend. So you are going to see marketing expense grow in the back half here. And it's going to be a really key selling season for them. Obviously, back to school is critically important for Q3 and for holiday. And the effects of the campaign so far have been really profound. I mean, I think I was on the phone with management last night, and they had said that they've seen new customer growth in, I think, every county in the U.S., which is absolutely amazing.
That is actually quite stunning. You just mentioned the marketing spend a minute ago. How does this translate into margins? Because I believe so far they've been able to protect their margins, but how big does the spending grow? How big does it get? And then what's the execution strategy?
Sure. So this company's historically averaged operating margins of about 8% pre-COVID, let's say. And today they're at around like mid-single digits, like 4 to 5. And there's an opportunity to scale up even higher. So I think that's the opportunity. It's going to be led by top line growth, which is obviously fueled by spending. But the question is, how do they rein in spending? The other element is promotions. And it's really nice to see that in the quarter, the company actually had lower promotions. But this all comes in the broader context of in the first quarter, they took, I think, $75 million of inventory write-downs to get the inventory in a really good shape for the back half. So there's some puts and takes here as it relates to actually kind of building sustainable, profitable performance in the business. And I think a lot of investors are waiting to see that prove out over time. But obviously the near term is quite exciting.
Well, I think sustainability is the key there. You don't want to be a one-trick pony with all these celebrity endorsements, although of course they help. We talked about some of the issues. What are some additional levers that the company can pull going forward that might enhance their sustainability over the long run?
So there's two really key growth drivers here that come to my mind, and they're Aerie and offline. And along with those two elements, you also have core Eagle growth, and they have a very strong denim share. But I just want to zoom in on Aerie and offline because those to me have been the really key tenets of the growth thesis throughout the last several years. Even you could go back a decade for Aerie, but offline's relatively new. It's their athletic brand. But I think that Aerie has been on a really nice trajectory, and then it's had some kind of fits and starts to the year in 2025. And a big component of kind of the weight on shares has been the underperformance of the Aerie banner. And they've had to, also a big part of the write down in Q1 was the inventory write-downs at Aerie specifically, and they had comped negatively, but it was nice to see it flip positively in the second quarter. And so as if this business continues on this positive momentum, positive track, then that could be an additional lever of growth. And then you also have offline, which I mentioned was their athletic business, and it's growing very, very strongly. I think the margins are good because generally athletic apparel margins are quite strong. And there's a lot of growth, and they're putting in these stores side by side with existing Aerie and Eagle stores. And I think that there's a lot of growth to be had there as well.
I want to broaden the discussion for a minute here. It's September. That means we're thinking ahead to the holidays already. It amazes me every year. But how do you see apparel retailers? Talk about the field. How do you see them preparing for the holiday season? Which ones are best positioned that you are able to speak on?
So our top pick within the mall today is actually Hollister for back to school. If you take a look at the data, so our foot traffic trends, you have credit card data that's also available. The trends have been very, very good for Hollister. We've seen double-digit growth in the brand. They're seeing traction across men's and women's. They just launched a new partnership with the NFL, and that's doing very, very well for Abercrombie. So I think that is a business that is very well positioned. Stock is cheap. You have continued positive momentum at Hollister, Abercrombie flipping positive potentially by the fourth quarter of this year. And again, supported by, I think, the NFL partnership, bringing in dresses and things of that nature that are probably higher ticket and going to help to elevate the offering over time. The one variable in all of this is, of course, tariffs. And I think that the brands that have a lot of heat are seeing really good traffic momentum, are marking down less, probably are the ones that are going to be best positioned to navigate this environment that we're in. So A&F, given where valuation sits and the top line trends and margin trajectory, that to me feels like a really good opportunity here in the coming months.
All right, I'm glad you addressed tariffs because that was going to be my next question, but instead we got about 30 seconds and I'm going to corner you here. Any guesses as to the next big celebrity denim campaign?
Oh, goodness. I don't know. That's a great question. But unfortunately, I really have no idea.
That's fine. We'll leave it there. We really appreciate your insights here. Thank you, Corey Tarlow.
Thanks.
And coming up, full market coverage ahead in the second hour of Market Catalyst. Do not go anywhere. Coming up this hour on Market Catalyst. First up, defense companies looking to capitalize on spending from the Trump administration, how investors should be playing the sector right now. Plus, President Trump's Fed nominee, Stephen Myron, in the hot seat on Capitol Hill today. We are tracking the Senate confirmation hearing live. And jeans are back. How to play the denim trade as jeans makers see rising sales. And with 90 minutes into the start of U.S. trading, I'm Jared Blikre. Let's get a quick check of the markets here. And you can see the Dow on your screen. It's up 123 points, or about 1/4%. We'll just check in on the intraday price action. We are at the highs of the day. Not a huge movement, but I think investors will take it. And then here's the NASDAQ up a similar amount and off of the highs that we had earlier in the session there. And finally, the S&P 500 up about 0.3%, trading at its highs of the days too. And I want to show you what's happening with the 13-week T-bill yield, and that has actually ticked down to 4%. We haven't seen that level in a few years, so that's pretty interesting, noting that America and investors are pricing in those Fed rate cuts. And then if we extend the look out on the curve, we can see that the 10-year Treasury note, that is down to 4.2%, down 1 basis point after a big drop yesterday. And finally here, we got the 30-year T-bond yield, that is at 4.9%, rising 1 basis point after the biggest drop yesterday since August 1st. And a quick look at the sector action, we still have consumer discretionary in the lead. That's XLY up 0.9% in the upper left there. That is an Amazon trade. That is up 2-3% today. And then to the downside, we are seeing materials, utilities, and now tech trading slightly into the red. Moving on, Science Applications reporting a beat on second quarter earnings, and the company missing on revenue estimates for the quarter and slashing its full year revenue outlook. Science Applications, a U.S. government contractor, noting that slower on-contract growth and continued delays in new business awards and new program ramps are contributing to a more challenging revenue environment. And for more color on what this means for the defense sector, let's go now to Christopher Kirchhoff, head of Applied AI Strategy and Global Security at Scale AI. And thank you for joining us here. Why don't you just take us through some of these earnings for SAIC and tell us what they mean, maybe not only for the company, but more broadly for the defense industry, which we've really seen the stocks humming this year.
Well, for sure, Jared. I mean, the defense industry really is growing. And I think it's important for investors to take note of two trends. The first is that there just is a lot of demand. I mean, just this week, we've seen the G Summit, of course, in Beijing. We're also seeing Europe double down on security guarantees to Ukraine. So there is growth. But in the same way that we're seeing the dip of earnings today in SIAC, the market is changing. The new defense team is introducing a lot more flexibility in how it buys technology. And I think that's beginning to push the market to shift a little bit.
And we've seen a lot of initiatives like Trump's Golden Dome project and companies kind of scrambling to get in the door there. What's developing on that front for these companies?
Well, Golden Dome is important, but I think there's actually two even deeper trends happening right now.
Please.
The first is that the Pentagon for a very long time has organized its buying by something called the JSIDs, this enormous bureaucratic process of developing requirements that companies then bid against. And just last week, Secretary Hegseth blew that up, opening the door to much more flexible contracting. So that's one trend. The second trend is that Congress is right now changing the way the department will buy technology as well, through language that Senator Wicker is proposing in the Forge Act. So a lot of changes coming to how the Pentagon deals with companies and buys technology from them.
That sounds pretty big. So could you outline how this would change the game for investors maybe? Sounds like the first thing you were talking about changes the bidding process. Maybe that happens a lot quicker. And I'm just thinking in general, could be part of President Trump's large deregulatory agenda. I'm not sure if it fits into the regulatory umbrella, but tell us what it means for investors, these kinds of moves.
Well, it's one of these issues that the details really matter. So the JSIDS process for 30 years has published lengthy regulations that essentially predetermine what kind of technology should be developed. And this was a system that companies like SIAC and a lot of the other traditional defense primes got very good at working within. And it did produce some really important technology. But after the memo that Secretary Hegseth signed out on August 20th, that system no longer exists. We are in new territory that is allowing each of the military services to surge ahead to identify new technology areas important to them and to make much more exploratory contracts. So this really is a macro shift in the market that I think will advantage over time new entrants.
And what do you think then some of the key risks to this sector are?
risks really are going to be about not keeping up on the one hand with the way the contract bidding process is changing on the Pentagon, but more fundamentally, Jared, it's going to be about technology and the way that warfare is changing. We're already seeing the early impacts of AI on combat systems. We're certainly seeing the impacts of autonomy on the battlefield. This is the future, and the Pentagon is right now making big moves to get ahead of it.
Let's talk a little bit about AI. I'm really glad you brought that up because at least in the private sector, and I've got a front row right here, AI has seen a lot of hype, but it's been slow to see businesses actually implementing it. How is this working out with the United States government, especially the military?
Well, the military has been a leader on AI for a very long time. I mean, DARPA's been working with AI since the 1950s. And I think we are beginning to see some very important developments with AI in the military, whether it's autonomous mine detection, whether it's autonomous undersea platforms that are going to be very important for conflicts in the Pacific. We're already starting to see some very big moves into autonomy by the Navy, particularly by the Air Force as well. So I think actually the Pentagon is quite ahead of other Fortune 100 or 500 companies in their adoption of AI.
That's quite interesting. I want to switch gears a little bit and talk about the impact of tariffs. President Trump is trying to get the Supreme Court to review a lower court decision that struck them down. But let's say that tariffs do continue going forward. How does this impact the defense sector?
Well, tariffs are going to be obviously a big part of the conversation diplomatically between President Trump and other nations around the world. But at the same time, he's very clear about selling U.S. defense technology to our allies, making that a very important pillar of his foreign policy. And so I think what that means for U.S.-based defense technology companies is the chance not only to sell to a Pentagon that's looking to buy more technology, but also to sell to U.S. allies and partners. So I see the global market for defense really going up by quite a bit, and that not only going up, but aligning with the Trump administration's foreign policy.
And just thinking ahead to tonight, I just got word earlier today that at the Rose Garden at the White House, there's going to be a big meeting among tech leaders. Elon will not be there, but Mark Zuckerberg is going to be there, Sam Altman from AI. And I'm just wondering, my question for you is more generally, what is the relationship between big tech and the Pentagon and some of these other defense contractors? How does it all fit together, and how do you see that going forward, shaping the future here?
Well, it's really changed. Back when I helped start the Pentagon Silicon Valley office in 2016, a lot of people in Silicon Valley were not so sure they wanted to work for the U.S. Department of Defense. But of course, in the years since, we've seen Putin start a land war in Europe, and sentiments have changed. And so now I think you're seeing the coming of full circle of technology companies that have really powerful technology being willing to apply that in national security applications. So you see companies not only like Google, like Microsoft, beginning to do more business with the government, but there's a whole new slate of companies, whether it's Anduril, Palantir, of course, has been on the scene for some time, but the company that I now work for, Scale AI, that are all new entrants into the defense market from Silicon Valley that have come about in just the last 3 or 4 years as a result of a tremendous shift in investment by venture capitalists here in Silicon Valley.
All right, that's all the time we have, but really appreciate your insights and your authoritative voice on this subject. Thank you, Chris. And coming up, what imports data tells us about the incoming holiday shopping season. We just got the latest figures on the U.S. trade deficit for July, which widened to a 4-month high as companies rushed to bring in additional goods before the steep tariffs went into effect in August. The value of imports rose nearly 6%, the highest increase since the start of the year. And now Mario Cordero, Port of Long Beach Chief Executive Officer, he joins us now. Thank you for joining us here. And let's start with the volume that you're seeing. I understand that July was a huge increase up from the same month last year, and you're looking at almost a record here, at least a record for July. How is this impacting, and what does this say about trade to you?
Well, I think it's good news for trade overall. So as you've indicated, we've had very good growth here for the month of July. And again, the worst scenarios that we thought back in April and May have not occurred. So there you're looking at a number of 944,000 TEUs that were moved here to Port of Long Beach. And when you look at the Gateway, which is the San Pedro Bay complex, which includes the Port of Los Angeles, that's 1.9 million in July. So again, rather surprising, but again, obviously it indicates that we have a healthy economy and consumers are spending, although we see some pause or softened spending in the future. But needless to say, I've indicated there's a lot of front loading of imports. The nation overall increased 17% year to year. You go back to July. So for now, I think, again, we're stable or good news given worse scenarios that we thought about maybe a couple months ago.
Well, I want to, since you mentioned consumer spending perhaps slowing down in the future, I'm wondering, does this relate to the holiday season? What are you looking ahead towards?
Well, we've been in a period of uncertainty when you talk about the trade sector, and of course, overall, macroeconomic factors, which again are impacting whether positive or negatively with regard to what that forecast is. So, despite the pretty good peak season that we're having, that is the month of July and in the summer here, we are still forecasting maybe a reduction of 10% year to year for the second half of the year. So again, that's the forecast right now. And as you've indicated, the consumer spending has reduced in the last couple of months compared to other high numbers that we had previously. So it is a pause that we should take in terms of what the remaining of the year would look like, particularly the fourth quarter.
And there's a lot of uncertainty right now, especially with respect to President Trump's tariffs, which may hang in the balance of the Supreme Court. And we could get a decision on that in the next 4 to 6 weeks, perhaps. Or maybe we don't get a decision on that, and the decision is just to let the lower court repeal of the tariff stand. How does this influence your forecasting? What do you expect in these different scenarios, if you can even anticipate that?
Well, obviously, those are factors that have to be taken into account in terms of what that forecast is, including the November 10th date. As you know, there's a 90-day pause from August with regard to the China-USA tariff trade discussions. That's another big factor that I think in this industry we're waiting to see some final resolution. The good news is there's been some trade agreements, as has been reported in the last couple of months, particularly in the last 30 days. However, again, the industry needs more clarity in terms of what those agreements are and what that impact ultimately will be on trade and, of course, on tariffs. So last, I will say, I think the one thing that we can say is prices are going to increase. It's just a question of how much. And right now, whether you're a manufacturer, a producer, a retailer, or a shipper, everybody's trying to kind of reduce that ultimate cost, percentage cost of tariff to the consumer.
And I want to talk about the de minimis exemption that recently rolled off. This was for products that were imported that were of a value $800 or less. And there's a lot of confusion around this, and it's impacting some of the things that I've tried to order overseas. So I'm wondering if you have any projections and how this is factoring into your analysis of the trade situation and what you do.
Well, certainly for the mid and small shipper, and of course the average American consumer, that's a big impact in terms of the exemption that we had, as you referenced, the de minimis exemption. So that's going to have an impact with regard to some of the e-commerce purchases that we are used to seeing in terms of that increase. And of course, there's BCOs or not necessarily BCOs, but in terms of people who are buying or used to buying through the de minimis option. Now, of course, again, they have to think twice because of the tax that's going to now and duties are going to be applied to that. One last thing with regard to that, there are shippers who are looking more to a forward trade zone option to reduce the duty and the tariff impact.
And finally, we got about 30, 40 seconds left. I want to ask you any key shipping or indicators that maybe your office controls, some important stats that people should keep an eye on that may portend future weakness in the general economy.
Well, number one, blank sailings, which means sailings that have been postponed or eliminated by the international carriers. That number for Long Beach right now for the next couple of months is around 21. That's something to be concerned about because, again, that indicates perhaps less volume coming to the gateway. So that's one. Second, keeping an eye on the inflationary number. We're at 2.7%, the CPI. And of course, that also reflects on the consumer confidence and ultimate spending, that we're seeing some softening, even though we have de minimis growth in the last couple months. But if you look to year, again, that's areas of concern that we have to look at those figures because ultimately it's consumer spending that really drives trade in this economy.
Very, very helpful and really appreciate your time here. Thank you, Mario.
No, thank you for the invitation. Very appreciate it.
And all your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you're still seeing green across your screen here. We're actually escalating some of those gains. We have the Dow up now over 170 points. The NASDAQ Composite and the S&P 500 are both up around 0.4%. And this comes after we saw fresh job numbers earlier this morning that showed private hiring slow to just 54,000 jobs in August. That was weaker than expected. Jobless claims also hit a 2-month high, although we did see ISM data showing that services activity has been improving, although hiring did shrink again last month. Now, this all reinforces expectations for a September rate cut in just a few short weeks. Markets are pricing in with near certainty that we will see that 25 basis point cut. But Friday's jobs report, that's going to tell us how deep cuts could potentially go. So all eyes are going to be on that August jobs report. Meanwhile, Fed independents also in the spotlight here as the Senate is weighing Trump's nominee, Stephen Myron. Concerns there have Goldman warning that gold could soar near $5,000 an ounce if the Fed's credibility erodes. And to that point, let's take a look at where gold is currently trading, because we have just seen record high after record high for this precious metal. We are now up over $3,600 an ounce. Year to date, we have just continued to be at those all-time highs, soaring over 35% here. Now, on the corporate side, I want to take a look at some trending tickers because you are seeing Salesforce, for example, lower about 6%. Now, this comes after the company slid on a soft revenue outlook. American Eagle, meanwhile, is just continuing to outperform, up over 32% after its Sydney Sweeney, Travis Kelce ads boosted their sales forecasts. Earnings are still to come from names like Broadcom, Lululemon, and DocuSign, but clearly a lot of individual stories as well as the macro picture that investors are focused on today. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Figma, HPE, and GitLab. First up, Figma. Those shares sinking after its second quarter results. This is the first quarter for Figma as a public company. The software design company reporting a beat on revenue and providing a better than expected third quarter revenue outlook. However, analysts noting that the results were not enough to appease Wall Street's high expectation. And Yahoo Finance's Ali Canal is with me now. And Ali, I remember the Figma IPO just a few months ago. They IPO'd at $33. It opened at $80 and it closed higher on the day, but now it's trading below that open price, although still above the IPO price of $33.
Right, Jared, we've just seen this hyper volatility since that IPO. Since debuting with that near 300% pop, shares have lost more than half their value. It's now trimmed its market cap to just around $27 billion. But you're looking at that share decline today, down nearly 20% at the moment. The first time the company is reporting earnings as a publicly traded firm. You noted that Q2 revenue jumped 41%, slightly above estimates. Now, Piper Sandler called the report largely a non-event. Bank of America, meanwhile, noted that the Q3 outlook, so that was 33% growth, that's nicely ahead of their 29% estimate, and it comes with no AI contribution. Still, BofA saying that results weren't enough to justify this lofty valuation as we've been seeing. So we'll have to continue to watch this name in particular to see if they can impress Wall Street enough to justify these high valuation costs, which is really what we've been seeing across the tech space.
Yes, and interesting to track that IPO hype as well. Next up, we're going to take a look at Hewlett-Packard Enterprise, that's HPE. The company topping third quarter revenue estimates and lifting its full year earnings outlook. HPE highlighting customer demand stretched broadly across its portfolio and was particularly strong in its server and networking segments. Allie?
Yeah, so shares jumping. There was that 54% surge in networking revenue that was fueled by that Juniper acquisition. Overall revenue topped expectations, though margins were soft across servers, hybrid cloud, as well as networking. So something of a mixed bag when we look at earnings in totality. Guidance did look stronger for networking, but weaker for services and hybrid cloud. KeyBank out with a note saying that the October 15th analyst meeting, that's going to be the real test whether HPE can, prove that it can integrate Juniper and capture some of that market share. The firm, though, is still staying sector weight, calling the stock fairly valued, given that high growth has already been priced in at these current levels. Now, UBS had a similar view, raising its price target to $23 from the prior 18. It also kept a neutral rating on the stock. The analyst there noting that Juniper drove the upside while core margins were soft, but should improve in the fourth quarter. So perhaps a bit of a show me story despite the jump that we're seeing in shares this morning.
Thank you. And finally, GitLab reporting a beat on earnings and revenue for the second quarter, but the software company providing weaker than expected third quarter revenue. And this is a competitor to GitHub owned by Microsoft, but what are you seeing on this stock, Allie?
Right. I mean, the CFO, Brian Robbins, announcing he's leaving for a competitor, Snowflake. Robbins has been at GitLab since 2020. He's going to step down September 19th. He will take over at Snowflake in that same role on September 22nd. And in the interim, GitLab did name VP of Finance James Shen as that CFO position. But, the C-suite shakeup did overshadow some pretty strong results. I mean, GitLab posted fiscal Q2 EPS of 24 cents on $236 million in revenue. Both of those were ahead of estimates. The company also raised its full year outlook while notching double-digit growth in large enterprise customers. And Jared, we've been talking at length about the AI talent wars, whether it be Meta poaching from OpenAI, even this most recent example between GitLab and Snowflake. So not totally surprising here to see this happening, but it just really underscores how competition for leadership and expertise is just across the entire sector at this point. I think we could continue to see more C-suite shakeups down the line, especially as AI and all these technological advances make their way throughout all of these different companies.
Yep, you're right. The executives tend to get the headlines and overshadow the results sometimes of the companies. All right, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. And President Trump's Fed nominee, Stephen Miron, in the hot seat on Capitol Hill. You are looking at live pictures of Miron facing questions from the Senate Banking Committee. Yahoo Finance's Jennifer Schomburger is live on Capitol Hill. Jennifer, what are some of the biggest takeaways of the hearing so far?
Jared, I just stepped out from this hearing, the Senate Banking Committee hearing right here in the hallway, and I can tell you that central bank independence has been the #1 topic. Both questions from Democrats and Republicans on this front. Committee Chair Tim Scott opening question and answer sessions with Miron, telling Miron how important it is to retain central bank independence and asking him to affirm what Miron had told Scott previously in conversations ahead of this hearing. Take a listen.
Dr. Miron, let me start with you. We had a conversation. My first, second, I think third question had to do with the independence of the Fed. I think the Federal Reserve needs to remain quite and completely clear in its independence. Certainly, as I said on the call, you share President Trump's vision for what it takes to move our economy forward. But I want to make sure that the answers that you gave when we were talking are still the answers that you have now as it relates to your role as a governor of the Fed and not as the chairman of the CAE.
Myron affirmed he will act independently. Meanwhile, the ranking member on the Senate Banking Committee, Senator Elizabeth Warren, tried to question and press Myron on just how independent he would be with a series of questions. She started out asking Myron whether Donald Trump won the 2020 election, to which Myron responded that Congress certified results for Joe Biden. She repeatedly followed up on that question, to which Myron repeated the same answer. She also asked him whether the Bureau of Labor Statistics tried to fake jobs numbers and make economic data look better under Biden, which Myron did not outwardly answer. She grew increasingly frustrated with him. Take a listen.
In other words, just two straightforward questions about your independence, and you've blown both of them.
Now, Myron says that he will actually take leave from his current position as the head of the Council of Economic Advisors at the White House if he were confirmed to be a member of the Federal Reserve, as he says that this term would be for a short term of only 4 months. So essentially saying that he is going to remain a White House employee, but on leave. That is what he has said he has been counseled to do, to which Senator Jack Reed, a Democrat, said, "You're going to be an employee of the president on leave? That is, quote, ridiculous." Now, Myron was also asked whether anyone in the administration has outwardly asked him if he were confirmed to lower rates, to which Myron said, "No, I have not." Jared?
Well, some heated exchanges there, and thank you for being on that beat,
Yes.
Jennifer. All your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Taylor Swift and Travis Kelce's engagement has the world buzzing. And sure, some of it's about the ring and the music star finally finding forever love, but a lot of the conversation, we know, did quickly turn to something else: a prenup. A prenuptial agreement, or prenup, is a contract couples sign before entering a marriage that lays out how assets will be handled in the event of divorce or even death. Speculation makes sense. Taylor Swift's net worth estimated at $1.6 billion compared to Travis Kelce's $90 million. That's according to Forbes. That's a big, if enviable, gap. But one of the biggest misconceptions about prenups is that they're only for the rich and famous. Well, our next guest says that's not the case. Here to talk about how you might benefit from a prenup is Lauren Crane, partner at Bender & Crane. Lauren, it is great to see you. So a lot of folks, Lauren, might think, they hear prenup and they think, well, that makes sense for the very wealthy, but not for everybody else. Is that true?
No, prenups can be used for anyone. If you have a business that you've created and you're trying to make it, you've worked on it for years and now you're getting married, you may want to protect what you've created before the marriage and agree that only the increase in value of the business may be marital. When you're doing a prenup, you decide what would be marital and what would be separate. So you make your own course of action when you get married. It's like a choose your own adventure book when we were kids, right? So your attorney will give you a few options. Here's what you can make marital. Here's what you can make separate assets. Here's what you can do with spousal support. And then you give the client or the couple the options, and then they choose how they wish to proceed with regard to how they want the laws to govern their marriage.
And Lauren, what would typically go into a prenup?
So typically, you decide assets that I have prior to the marriage are my separate property, and here's how we can share it, or here's how I can protect it. Assets that we acquire during the marriage are either going to be considered separate property of the person who earns the money or however they've accumulated the assets, or it could be marital. You can also agree on how to divide those assets. So there's community property states, and then there's equitable distribution states. In equitable distribution states, it's an equitable division of assets, so it's not necessarily 50-50. So you could agree that all those marital assets are divided 50-50. You could also decide how you want to treat spousal support. So whether you're going to waive spousal support upon a divorce or how you're going to calculate your income for spousal support. And so you can decide that. You can also decide what would happen if someone were to pass away while you're still married or after the commencement of an action. So you can decide so many things in a prenup, and it can really work to both of your advantages.
Let's say I'm a viewer, Lauren. I'm listening to this right now. So, Lauren's making a lot of sense. I'm going to get this prenup. If I go to a lawyer, how much am I looking at to get this prenup? Can we put kind of a broad figure on it, roughly?
So I can't really put a broad figure because every attorney costs a different amount. But I can tell you that if people talk, the couples talk about what they want to put in the prenup, and they decide together and they work together to figure out what they want in the prenup, the cost of the prenup will go down because you're dealing with your attorneys on much less issues. So the more that the couple can talk and agree, the cheaper the prenup.
How long is the process usually, Lauren, or can it be to get this done?
So typically it could take, a few weeks to do a prenup, or it could take several months. It depends on how much the couple talks to each other, right? So if two attorneys are dealing with a prenup and they agree on the concept, you need the parties to agree. And the more the parties can work together, the shorter the line.
Are there risks to doing a prenup? I think a lot of people, Lauren, probably think, maybe it makes sense, but I kind of don't want to broach it because I'm worried it's going to create some relationship tension or strain.
So everyone asks me that question, and I want to say, before you get married, you think that you're going to walk into this marriage and then you're never going to have to talk about money. The day after you get married, you have to figure out how much you want to pay for rent, whether you want to send your kids to public school or private school, how you want to spend your money. Do you want to save this amount? These are just conversations that you can get into before you actually get married. Everyone thinks that once you get married, all these decisions are made. Yet, once you're married, these cause the biggest issues in a marriage.
Fair enough. Lauren, it was great to have you on set today. Thank you so much.
Thank you.
Retailers came claws out ahead of the back-to-school season with dueling celebrity denim ads as they battle for the few dollars that choosy consumers are willing to dole out. American Eagle's Sydney Sweeney ad used controversy to boost sales in its latest quarter, while Levi's, they leaned into its synergy with Beyonce. Meanwhile, Gap tapped into the younger audience with K-pop group Cat's Eye. Gap Inc. CEO Richard Dixon had this to say about the collaboration on Yahoo Finance last week.
This campaign, which launched last week starring Cat's Eye, it has driven record-breaking response for the brand. Early reads, I would tell you, Better in Denim is striking a range of being one of the most iconic brand campaigns out there. People aren't just watching, they're actively joining in suggesting this is not a cultural conversation, it is a cultural takeover. This has all the elements of Gap global phenomenon. And this is where, and we've talked about it, fashion meets entertainment. Fashiontainment.
Joining me now is Stacy Widlitz, president of SW Retail Advisors. Really happy to have you here. Just talk to me about the trends. I walk the streets of New York and I've noticed some Western wear kind of gaining steam here. And it is kind of the Wild West sometimes on these streets, but what are the trends in place and how does they relate to denim?
Well, you said it. It's all about Western wear, and we've seen that show up. We've seen it in full price selling at Levi's. We've seen it from the Buckle. We've seen it from the Gap. We've seen it in a broad array here. And if anybody thought denim was dead because stretchy pants made us all too lazy and comfortable, they're wrong. It's full force. It's back. It's been that way for about a year now, and you're seeing it on the street, whether it's cool boots or cool denim. And of course, as the collaborations that we've seen in the market have really, really resonated with the consumer and brought that trend to them in a very usable way.
Yeah, the collaborations being discussed and talked about as a takeover, a fashion takeover. I found that interesting, but who are some of the winners here that you can figure or identify for us?
So I think number one, what you've seen going on with the Gap. The Gap went from, on sale all the time, 50% off all the time, to more full price now. Now you're seeing up to 50% off, not 50% off everything. And that's a direct result of their denim campaigns and their denim upgrade, their better fashion. So they're starting to sell product at full price, and the customer is not only looking for discount stuff from them. So that's been a big change. The other one is Levi's. Levi's, again, their average selling prices are up, they're discounting less, and the consumer is buying it. You saw that Beyonce campaign that's been incredibly effective. And of course, last night we heard from AEO, American Eagle, that talked about the Sydney Sweeney campaign, which has been really effective. Sellouts, controversy or no controversy, it's been a home run.
Well, and you just talked about stretchy pants kind of being out of favor. And first stock or company that comes to mind is Lululemon, but also Gap has exposure to this kind of industry because of Athleta. So talk to me about some of the people who might be losing out on this trend.
Sure. So I think, Athleta has been floundering for years. They just haven't been able to get it right. The cool factor hasn't been there. Meanwhile, you've seen Viore and Alo and Lulu, rocket, and Athleta's just never really gotten its mojo back from years and years ago. So I wouldn't read into that so much as the market, but you're certainly seeing with Lululemon reporting tonight, there's a slowdown in the US, and that's a direct result of competition. And there's cooler brands, younger brands speaking to the consumer differently. Lulu has also expanded into so many categories that you go in the store and you're just kind of not sure what they're really, really good at. It feels a little overcrowded and a little bit like trying to be everything to everyone. So I think, the newer, cooler brands are absolutely growing and holding in there. But again, if you have this denim trend that's pulling that consumer dollar back away from stretchy pants, it's overly competitive right now.
I want to talk about the holiday season, and let's set denim aside for a second. Just talk about apparel overall. We have tariffs to consider. We have a lot of macro factors. How do you see the holiday season shaping up overall for apparel?
Well, there's no doubt that we're going to have price increases rolling into holiday, as a lot of the brands were able to pull forward inventory even into back to school. They weren't able to do that for holidays. So we're going to see some price increases. And I think you're really going to start to see the brands that are winning despite what the cost is and what the AURs are. And that includes a Ralph Lauren, that includes a Coach. Those brands have been selling full price and raising their average selling prices for well over 2 years and really getting away with it because the consumers are back and the brands are back. I would throw Gap back into that mix as well.
Any other trends you can talk about, putting denim aside again for a second?
Well, I think, there's obviously been a lot of conversation in the footwear and the athletic space with Nike. Will they ever come back? I'm starting to see a little more full price selling at Nike and a little bit of comeback there. So we'll see. I'm also starting to see a little more promotions at Adidas. So the big question is, are those brands going to be coming closer together again versus Nike on the downtrend and Adidas has just been on a straight up trend?
And then I got to ask you, any thoughts on who the next big celebrity might be featured in some of these denim campaigns or maybe any other campaign?
Oh gosh, I mean, if you had a wish list.
I put you on the spot, I know.
Wouldn't you put Taylor Swift right at the top of that? I mean, her fiance has been in some brand campaigns, so let's get her front and center if you have the deep pockets to do so.
I agree there. And just anything else for the viewers, what should investors in the retail space keep in mind as we head into the final months of the year here?
I think you really want to look at companies that are value plays because obviously inflation has impacted us all and it's going to get worse with tariffs and price increases that might be up to 15%. You still want to look at the tried and true TJX, Costco. Of course, Walmart is gaining share from the higher income consumer. That consumer is trading down to more value. So those are the stocks you want to have in your portfolio.
All right, and that's going to do it. Thank you so much for stopping by here, Stacy. And that is it for Market Catalyst. I'm Jared Blikre. Thank you for watching. More Yahoo Finance is ahead.